There's a lot to take in today and the rest of the week in terms of numbers on this economy. The second reading on second quarter GDP comes out later this morning. The economy here is expected to show growth of 2.7%. Kevin Kelly, maybe even 3%, even north of that. Let's bring in private wealth management advisor at UBS, Jason Katz. Your expectations for this, and does it speak to the overall sound growth of the economy?
The consensus is at 2.7. We're modestly lower than that. With what's happened with Harvey in the short run, it could deter from that number perhaps in next quarter by as little as 0.2%. But interestingly, looking at in the intermediate term, you could actually see an addition to GDP as a result of replacing businesses, factories, homes.
Right. That very often after, as horrible as these disasters are, you see a rebuilding, and that rebuilding begins immediately. You see a recovery effort, and that is money that does pour into these regional economies. But in terms of what's going on with Harvey, we've had so much of refining capacity knocked out. About 1/5 is down. That Motiva Port Arthur refinery is now shut down, largest in the country. We already had the Exxon Baytown, which is the second largest in the country, has been shut down. Problems potentially with the Colonial Pipeline, which sends gasoline from Texas all the way up to New Jersey. Are you worried about that, and at least that interrupting business activity in the short run?
In the short run, it's clearly going to be disruptive. I would think, however, that energy prices in the long run will follow the economy, and we're very constructive on the economy. So we see oil north of 60 looking out roughly 12 months from now.
So really, because of demand, on the demand side?
Correct.
Global economic.
Exactly.
So we're only a couple % off the all-time highs in the markets right now. A lot of people feel like the markets are overvalued. Now, I think earnings are worth more in a low interest rate environment, but what's your take on how the markets are going to perform going forward? Because I don't see any impact of regulatory changes or tax reform baked into earnings estimates. So should we get that? Can people buy the market here? Can we break these all-time highs?
It's a great question. All of our advice is predicated on a customized financial plan, which informs an asset allocation. And part of those asset allocations are tactical changes. So to get to your question, we're actually modestly reducing equity exposure here. I stress modestly, and for a variety of reasons. Namely, to your earlier point, valuations at 18.5 times earnings, it's fully and yet fairly valued. That said, there's a number of reasons to be constructive on the market if you look out over the course of the intermediate to long term.
So where are you putting that capital then? If you're getting out because bonds people think are even more overvalued in
with
this market.
the 10-year yield at 2.13% as a sign of it being overvalued, you wouldn't allocate more of your assets into U.S. Treasuries, would you?
Not necessarily. Now, let me stress, we're being tactical, so we're modestly reducing exposure. As far as redeploying that money, I tell clients it's oftentimes return of your money and not on it, because a big part of our job is not only growing assets but preserving them.
What is your outlook at, let's say tax reform doesn't happen in 2017, let's say it happens in 2018, what is your view on how that will affect small businesses? I know we're talking about the market here and obviously talking about larger scale, but what effect do you think that will have on small businesses, on consumer confidence, and how will that play out in the market?
Probably more so on small businesses and the psychology of the consumer and the investor, for that matter. Part of the rally was predicated on the hopes of deregulation and tax reform, and to some extent the market has discounted all of this occurring.
Right.
We do think you will get tax reform, perhaps not as large as we all hoped, perhaps not as quickly as we all hoped, but it's not a matter of if, it's a matter of when.
And you know what I was going to ask you today in this 24-hour news cycle, and when media is sort of dominating what happens in the market, how do you manage clients' expectations?
Well,
that's a really good question, Aaron, because I get that a lot. I have people ask me that a lot, like the market did this yesterday. More and more I get those questions from individuals.
So it's not easy, but look, I'm tethered to my iPhone, I'm tethered to your news program, and reading newspapers.
Thank you for the plug.
But the fact of the matter is it's my job to counsel people to look at things from a much wider lens and a longer perspective. And if we're making decisions within the context of a plan that at least goes out a market cycle and not a few months, we tend not to get harried in environments like this.
All right. Jason, thanks for being here. Jason Katz.
My pleasure.
And we're